Hi, everyone. We're really excited to be here to tell you about the technology we've been working on. And of course, we also want to thank the Avalanche team and the Avalanche community for inviting us to give this talk. So quickly, I'll just tell you a little bit about who we are. So my name is Patrick Kiefer. I'm the co-founder of Arrow along with Ed Mehrez. We both are financial economists by training. And I have a research background in asset pricing, banking, and applied mathematics. Done a fair amount of work on counterparty risk and asset prices, and also a fair amount of work on financial intermediation, which I think is particularly relevant for the type of designs that we're building here. Edward has an equally distinguished background in financial economic research. And some of his most recent work characterizes bubbles in asset prices using some tools from Martingale theory. So some pretty interesting stuff, but just to kind of give you our background. And Edward and I have known each other actually for about 10 years since we were studying math as undergrads at UCLA. And then our two main engineers, Austin Liu and Preston Roswood, joined us this summer at Cornell's IC3, where we began working on this protocol that we're about to tell you quite a bit more about. So what are the Arrow DFMs? So first of all, the Arrow DFM is decentralized financial markets. So what are the Arrow DFMs? What problem do they solve? They solve the problem of creating a reliably settled financial claim on any outcome with very little overhead. And so, how does it achieve this? Well, the way to do this in a context like blockchain is to implement a complete protocol for decentralized contract creation and settlement. And that is what the Arrow DFMs do. The Arrow DFMs implement a protocol for efficient decentralized contract creation and settlement. Each DFM is backed by a multi-tiered capital pool. And the DFMs discreetly enforce what we call a distributed balance sheet. And this is a concept that we are fairly interested in. We think it's fairly interesting, but also powerful. And so we're going to say a few more things about what a distributed balance sheet is later on in the talk. So in order for me to describe a little more about what the innovation is and what it is that we're building, let me give you just some kind of basic background so that the language I'm using, makes sense to enough of the listeners. So a call option gives the owner the right to buy some underlying asset at a previously agreed price called a strike price at some time in the future. Traditional options are traded up to an expiration time, after which the option contract itself is settled by making physical delivery of the underlying asset. And so this is a traditional options context. So cash settlement is a little bit different. Cash settlement is when an option liability is paid in cash rather than the underlying physical assets. So when physical assets are not readily available for settlement, cash settlement is used. Some examples in existing financial markets are SPX index options are cash settled, for example. But for the most part, options are settled physically. Physical settlement for the case when the underlier is a stock is just a matter of delivering shares. So physical delivery can mean deliver shares, but that's still different than delivering cash. And so delivering cash is, it turns out, necessary in a setting like blockchain where the physical assets don't exist, but it also has a lot of advantages. So what is the Arrow DFM platform? How does it achieve the goal how does it solve the problem we set out to solve? Well, it standardizes the creation and cash settlement of options on any reference asset. So with this system, what we can do is we can take any underlier, we can create this system around it according to this protocol called the decentralized financial market. And the decentralized financial market allows users to create all the different option types that they may want on a particular underlier. So another great advantage of this is the ability to kind of create the flexibility to create these options has additional advantages. So one advantage that we're really excited about is the fact that you can actually just translate this machinery into a standardization for the creation of stable coins and cents, because there are particular portfolios of options that achieve this synthesis. So once you nail the options, then you can do this type of synthesis in a fairly straightforward way. So we think this is, setting up these efficient decentralized settlement systems can be very powerful. We're very excited about all the things that kind of are possible there. So let me say a little more about how it standardizes the creation and cash settlement of options. So it works by coupling what we call a decentralized aggregate counterparty with an option factory for each underlier. So the decentralized aggregate counterparty is also a fairly fundamental and important concept, something we also think is very interesting. So we will also come back to that a little bit more later in the slides and say some more about the decentralized aggregate counterparty. Once the decentralized aggregate counterparty is established, users can create any contingent claim on that underlier. New assets can be created by combining claims across and within DAX. So I can customize exposure to a particular underlier in very specific ways, but I can also customize exposure across underliers. Importantly, assets linked to these decentralized aggregate counterparties inherit the settlement guarantees. The decentralized aggregate counterparty is essentially the set of functions that enforce the settlement for the contracts created on the DFM. So any of the contracts created on the DFM have the same safety protocols built into them. So again, to reiterate, what we're calling a decentralized financial market is the coupling of this decentralized aggregate counterparty and an option factory. So this diagram should kind of illustrate the nature of the DFM a little bit more clearly, hopefully. Particularly, this should illustrate the fact that the DFMs are long-lived. So in this case, a user comes in, wants to create an option on an underlier U. A DFM doesn't exist for that underlier yet, so they have to initialize a DFM in order to create an option on U. But once one user does that, then no other user has to do that because the DFM is long-lived. From that point on, once the DFM is initialized in the system, subsequent users, when they search for the underlier U, they can just create options on it without having to create a DFM. So the DFM, once it's established, has this long-lived property that makes it very powerful. Okay, so we want to say a couple things about the user types here for decentralized financial markets. So there's something, we think it's very interesting the way that the implementation of the decentralized financial markets version 1 breaks the dichotomy between option buyers and option writers. Instead, there's a more productive distinction between user types in this context, and that is between traders and savers. So traders create options on the underlier of their choice in exchange for the buying costs of creating that liability and adding it to the DAX balance sheet. So traders encompass what we would formerly have called buyers or writers. Savers, on the other hand, fund the decentralized aggregate counterparty, the component of it that's responsible for over-collateralizing the claims made by traders. So the traders are creating these options in the first pool. The savers are sitting behind the scene, funding this financial engine to make sure the claims promised by the contracts created by the traders will be honored. In fact, they're kind of heavily over-collateralized in the presence of the savers. And of course, the savers are rewarded for locking up that collateral. And savers, so the way that we reward the savers is we have them earn fees generated by the traders' transaction. So there's a complementarity in terms of these user types for this system to work here. So we think this is a more productive dichotomy to think about traders versus savers in this system rather than buyers and writers. Okay, so where do we think these users might come from over time? Well, I think that the existing users of DeFi applications, there's a lot of reasons for them to use this type of technology. There are kind of clear advantages over what exists in the space to our knowledge at this stage. But we also think it's really important to mention that standardizing the settlement in the way that we propose makes it appealing over the medium term to another class of users, institutional users, traditional retail investors, fixed income investors, and so forth. Okay, so I just want to say a quick thing about what the advantages are to these two user types. We've kind of said this already, but it's worth kind of repeating. And then I'll pass it off to Edward to say a little more about the specific details of the early implementations of the technology. So for traders, as we mentioned, the advantage to traders is that they really can just customize their exposure to any set of outcomes that can be verified with a public API. So we think this is very powerful. So that's novel. That's a reason that traders would participate in the ecosystem. So savers also have some novel incentives to participate in the system, to our knowledge. Because the platform is cash settled, savers can just lock up cash collateral and earn income that way, rather than having to lock up a risky platform token. So we think both of these are significant advantages to these user types. And with that, I'll pass it off to Ed.
Thanks, Patrick. So I'm going to talk about a few things to round up the presentation. We're going to first talk about initial use cases, then some of the key components behind Arrow DFMs, and then we're going to finish up by saying how you can get involved, how the community can get involved, and how to stay in contact, ask questions. We want you guys to participate. We want to hear your questions, and we want to improve together. So in terms of some interesting use cases here, one of the kind of most basic but straightforward but yet powerful applications would be to create put options to cover downside for investors with long positions in, let's say, Ethereum or Bitcoin, ETH or Bitcoin. But you can also do things like create options that pay out depending on a performance of a large portfolio of stocks. We can do things on Arrow DFMs like create derivative claims on AVAX, such as AVAX VIX, AVAX SKU, AVAX kurtosis. Now, in traditional markets, users don't have this ability to create these assets that tell you something about the overall inherent risk in the market. VIX is available, right? But something that tells you about higher moments of a distribution, things like fat tail, skew, things like that, those are unavailable. However, on our platform, those can be created. Another very interesting thing is that our platform will allow extended trading of off-chain assets. Once those off-chain assets are synthesized on a DFM, then there's no reason that they can't trade 24/7 other than liquidity. So as long as there's users that are available, as long as they're trading on a DEX or an exchange, these can be traded. So 24/7, those can be available. And that's exciting because a lot of the time, there's jumps in markets. When markets open, close, here, we would smooth all those out. You would see information kind of get incorporated into prices continuously. In addition to that, stable coins that are attached to fiat currencies or commodity prices, those can be synthesized as well. In fact, stable coins are just synths that have the backing of some stable asset. So that would be the reference asset, for example, fiat currencies or commodity prices. And really creating claims to any on or off-chain asset in principle, such as the S&P 500, and then based on things like VIX, skew, kurtosis, as I mentioned before. All of that is possible with Arrow DFMs. So what's going to be the components, some of the interesting, important components about the V1, about our version 1? Well, of course, we're going to allow eligible users to create standardized contracts, standardized option contracts, and synths, which are prepackaged options, on underliers of their choice or reference assets of their choice, and allow the investors or savers, as Patrick mentioned, to finance the decentralized aggregate counterparties. So there are two pools that really work in tandem and comprise a DAC. And these help mitigate the counterparty risk. The risk that obligations that are due in the future, if you own an option or a bundle of them, will not be paid off. So what are the two pools? First, we have a collateral pool. And in there, option creators mint contracts to be exchanged by providing collateral set by the protocol. Okay, so there's a certain amount of collateral that's determined from the protocol. We do this with risk measures. I will describe that in just a little bit. And then that collateral is pooled by underlier. It's pooled by the DFM, actually. So in that case, the collateral pool, you really have hedgers and speculators that are participating in that. And they can create options in order to tailor risk exposures. Now, on the other hand, we have a tail liquidity pool, and that's going to be populated by liquidity providers. And that provides insurance to the first pool, the main pool, the collateral pool, if it becomes insolvent. So liquidity providers are compensated with fees collected from users of the platform. For whatever DFM or across DFMs, whichever ones they back, they are going to be compensated from use of these assets, from creation, from exchange. It's going to be how much our contracts are being used out in the wild. So in terms of what this looks like in a diagram, just to kind of reiterate what was discussed in the last slide. So we have our DFM, a simple diagram. We have our DFM, and the DFM is comprised of our DAC, which handles settlement, and option contracts. And then we have the users, the buyers, the writers, which are the traders, and the liquidity providers. So at time little t, when they come in, these buyers provide the premium, which gets stored in the collateral pool, and writers provide collateral for writing those option contracts. In addition, liquidity providers provide tail insurance capital that's collected. At settlement, then buyers get what are owed to them in terms of what the obligations are that ended in the money. And writers get whatever residual premia there are in the pool at time big T. And the liquidity providers throughout will get exchange and creation fees, as discussed before. So what are some of the some key features that we want to emphasize in version 1? Well, Arrow DFMs will provide users a platform that emphasizes ease of creating a market around an underlier or set of underliers, the DFMs. What that means, fundamentally, users can create either a short, that's a writer, or long buyer position in any option. And any set of positions can be combined to form a portfolio of positions. The DFM's atoms are standardized option contracts. And our platform will also provide prepackaged portfolios of options to create synths or stable coins. Those are popular products, and we want to have the users not have to go out and package these options themselves in order to create them. We want people to trade those. We want to make it easy for them to do so. Users can also easily create option spreads and limit their collateral liabilities. And again, since those atoms are standardized, this is important, so will those compound products, so will those portfolios of assets, so will the synths, so will the stable coins, et cetera, et cetera. Now, what are some of our planned initial DFMs? Well, we're planning on having a dollar DFM, an AVAX DFM, a Bitcoin DFM, and an ETH DFM. We may also have an equity portfolio DFM as well. What about in the mid-range? What about not just like the product launch and what will be available there? What is our kind of vision, part of our vision for the future? Now, Patrick mentioned this before. In the medium term, the platform really is engineered to appeal to institutional investors, traditional retail investors, and policymakers and regulators. And we do this in a kind of a multi-pronged approach. First, we cut out the middleman. We reduce costs. And there's also transparency, precision, and extensibility that Arrow DFM emphasizes. Our pooling and risk assessment techniques make us appealing to regulators who care about the safety of settlement. And that's an important thing to care about. Now, once we get regulators on board, that really opens up the realistic opportunity for institutional partnerships. Now that they can actually use the platform as it's deemed safe by regulators, then they can use, we can partner with them and have product development over the medium term. Now, what's a good example of this? Well, think of a DFM as an ETF design. So we can have partnerships where institutional investors, sell side comes in, they have deep pockets, and they're willing to put up the collateral that's needed in order to finance a DFM that has a particular ETF that it's offering. Now, in terms of even longer term views, we want to think about social good applications. And it's important to realize that although we've been talking a lot about, traditional finance stuff and settlement of options and so on and so forth, in the future, what we really want to have done, it's more sophisticated, but we want to have the ability for anyone with a balance sheet, let's say a firm, corner store, to finance shortfalls by selling claims to the revenue. So what do we mean by that? Suppose you're a corner store, you have inventory that you have to finance now, but you might not be able to bankroll it right now. You might not be able to put up the money up front in order to purchase those products. You may only be able to afford that once the products are sold in the future. So in that case, you can use Arrow and with this distributed balance sheet, and you can raise money in order for your inventory right now. So these types of examples require more sophisticated oracleization. For example, for that corner store, it would have to be the case that you keep very good track of revenues, costs, et cetera. So you see exactly what's happening. With things, partnerships with payment processors, that is possible, something like Square, for example. Now, there are lots of reasons why these capabilities are important to have in a more macro context as well. So beyond that risk sharing, investors using options in order to hedge and so on and so forth in financial markets, there's also things like securitizing education or apprenticeship and other non-traded types of human capital. So you may want to embetter yourself. You may want to go out there, get a better education, get an apprenticeship, but you're not going to be able to afford that right now. So what's one way you can do that? You can bankroll it by kind of trading shares of human capital in the future. Okay, so let's talk a little bit more about the key components of Arrow. We have initialization. So an asset is defined by the future payouts it promises, and it is priced according to how risky these payment streams are deemed to be. A lot of people know that as a discounted cash flow model, where you're discounting by both your time preference as well as risk. Given an underlier price referenced by a public API, the contract programmatically defines the cash flows for a particular asset. When the underlier already has claims in the system, in other words, it has a DFM, creating a new contract is just a matter of accounting, really. Add the new liability to the pool, mint a new contract or asset that promises the corresponding liability. What are some of the challenges here, though? Well, a big challenge is, as Patrick alluded to before, cash settlement. A lot of assets are not on chain, okay? They're physical assets that are on New York Stock Exchange or, just anything that's available through a public API. And when this happens, when you settle by, when you have cash settlement, it's possible payoffs are unbounded. You can't completely cover them in all cases, especially since you don't have that physical asset to cover it. You can't do something like a covered call, for instance. So here's just some math explaining a little bit about how you can always have an extra dollar payoff, an extra dollar liability that you owe. And we have to consider how to make the system sufficiently safe. So this uncollateralizability is a big issue, but how do we address it? How do we mitigate it? Well, we mitigate it through our collateral determination protocol. So the risk profile of the pool is controlled on the margin by a market maker who sets contract buy-ins M equal to the amount of collateral needed to enforce a dynamic value at risk condition. So the protocol does this. The protocol determines from a entropic VAR, value at risk, which is an upper bound on regular value at risk. For those of you who may have heard of that, it's a risk measure that's common in regulatory amongst regulators. So we have an upper bound, entropic value at risk. And the way it works is when a DFM is initiated, those who initiate it have to put in the collateral that's determined by the risk measure, by the entropic value at risk. We're going to call that M0. Then as new contracts kind of come in, the buy-ins are set in terms of what collateral is needed to get those contracts. The buy-ins are set as the marginal difference between the entropic value risk before that contract was added and after that contract was added. So that is that difference there in value at risk. So what does this look like in a diagram? Well, let's kind of go over the recursive form of this. So first you start off in you have a distribution of contract liabilities in your decentralized financial market. From that, you can determine the probability of DFM insolvency. Given that probability, you can determine what an acceptable amount of risk is, what an acceptable amount of collateral is in order to have that risk be mitigated. So now, as a new contract comes in, the risk measure sets the new buy-in prices for both pools, for the collateral one and also for the tail liquidity pool. So as you can see, there's an updated buy-in price for tail liquidity, and then there's a marginal collateral requirement for the new option contract that's created. You can just think about those as both the new kind of price to participate in making that new contract. Once that new contract gets funded, it joins the DFM, and then we start over again. Now, we mentioned this a little bit before, but another exciting concept that we're trying to emphasize is a distributed balance sheet. And that DAC is really the thing that is the distributed balance sheet. It enforces it, really. So what do we mean by a distributed balance sheet? We mean a collection of address balance pairs such that the balances are locked at the address for some predetermined amount of time. And a local instance of an attacher contract then authorizes a balance to be credited or debited according to a function call from the DAC library to settle. So that's a little bit, gives you a little idea of what our contract suite, how it works in terms of being a distributed balance sheet. Finally, it's important to really discuss, as we are talking with you guys, the Avalanche community, it's important to emphasize how critical something like high transaction throughput and strong finality is to something like Arrow DFMs. And we're excited about Avalanche's capabilities in terms of the high transaction output, in terms of that strong finality. And it really is necessary for DFM transactions to scale. And in terms of being traded on a DEX as well, which Avalanche is developing in partnership with others, it's important for those assets to be traded without being front-run and at a very high frequency. We want to give the users the ability to really compete with traditional financial markets. And as we see it, Avalanche is a very good platform for accomplishing this. In addition to that, right now Arrow V1 is being built on C-Chain. But in our future iterations, V2 and above, we really want to take advantage of the custom VMs that Avalanche is planning to allow users on the X chain to use. So we're really excited about that opportunity, and we think that that could have levels of magnitude in terms of improving performance with respect to Arrow DFM. So just to kind of round out the discussion, we really want to thank you guys. We're really thankful for the opportunity to come here to discuss with the Avalanche community, Arrow DFMs, and what we think, is really the future financial engine, the engine of finance for the future. And we're excited about what can be done in this space. We're excited about building with the community. And if you want to contact us, please don't hesitate. Go to the website, arrowdfms.com, for more information, as well as our social media links. And if you have any questions, just hop on there and go ahead and ask them. Oftentimes, from questions from you guys, we improve the platform. We get different perspectives that we hadn't considered before. And it's really exciting to have that opportunity for such a high frequency of communication and feedback. Now, in particular, we're actively looking for front-end developers to help us make Arrow DFMs as powerful and easy to use as we know that they can be. And full-stack Solidity developers are also encouraged to get in touch. So if you guys are either of those, feel free to contact us. Also, if you just have questions about the platform, we're happy to answer those as well. Thank you guys so much for your time. And thank you to Avalanche for allowing us this opportunity to present our idea, our new and exciting idea, to the community.